The war in Iran is still going on, energy markets are going crazy, and the stock markets are reacting accordingly. All this and more we're going to discuss in this special episode, episode number 20, our little anniversary of my investment journey. But before we do all that, we're going to go right ahead into my weekly trade, which is, as always, a 1,000 euro investment in the MSCI emerging markets. So let's go ahead, put in the 1,000 euros here. Let's review the order, and boom! We got it. I think that worked. Let's go to the Wealth tab, and we are at 20,360 euros. Amazing! So we cracked the 20,000 euros. I was peaking a little bit throughout the course of the week, and we were already at one point over the 20,000 mark. So that's basically the high back then, 20,280. But yeah, since then we lost about 1,000 euros, and that's, I think, becoming the new normal. On the one hand, we have a very volatile stock market, but on the other hand, I have so much money invested already. 20,000 is not nothing, so that a 5% swing in the underlying asset means a 4-figure movement in my portfolio. All right, so what is happening in the markets? What we see is a differentiated picture. The developed world is down across the board, while the emerging markets are up. Although only half the countries that we have in our dashboard here are actually up and the other ones are down. Year to date, the developed countries here, or the MSCI world, is down by 2.5–3%, while the emerging markets are up by 2.5%. All right, so let's look at the stories of the week. And of course, the Iran war is still dominating the headlines, the third week in a row. Now, maybe you don't want to hear about it anymore, but it's just what's overshadowing everything else right now. It may blow over soon and we're back to normal, but we may also be looking back at this point in time and call it the beginning of a new era in geopolitics and the economy. We just don't know. So last week I talked about the Strait of Hormuz and how critical it is, and this week the situation only just intensified. Iran says anyone can pass the strait as long as it's not an enemy of Iran, or in other words, US allies. So Chinese ships can still pass. But of course, Iran needs to control the Strait of Hormuz as it's their biggest bargaining chip. The US want to open the strait, and Trump threatened Iran that he'll obliterate everything, including Iranian power plants, if they don't open. Trump has also complained about his allies and NATO that they aren't doing enough to help open the strait. Some coalition seems to be forming, but it's unclear what the exact plan is. What Trump is also considering is taking over the Karg Island. That's his way of pressuring Iran to open the strait. Why could that work? Well, that's the island where 90% of Iran's crude oil exports are processed. The idea is to further degrade Iran's military capacity, which takes about a month, they say, and then they can take it. And some US officials said, then we got them by the balls and then we can negotiate. To take the island, however, it probably needs troops on the ground and a coastal invasion. Risky, expensive, and it may happen. Marines are on the way right now, but nothing is decided. And just for context, where is this island? Well, it's actually not even close to the Strait of Hormuz. It's up here, while the Strait of Hormuz, as you can see, is here further down. Meanwhile, Pete Hegseth, the US Secretary of War, has asked for $200 billion in extra funds for the Iran war and just generally for the military. And he says it takes money to kill bad guys. So clearly that's a huge number, even compared to the gigantic US military budget, which is somewhere at 800 or 900 billion per year. Now, that's the situation on the political and military front. But what happens in the markets? Well, energy markets are wild. Here you can see the oil price, and remember last week I said the oil price shot up, and then Trump said the war was going to be over soon, right? And the markets dipped for a moment, but of course nothing was over. And so here we are, prices have climbed further, and now we must deal with that. As you can imagine, the stock markets didn't react too well to that. Here's the S&P 500, and it's down quite a bit over the last month or so. So yeah, almost 5%, and if you look at it from the peak here, it's surely more than 5%. But of course, not everyone is suffering equally. Here I have the S&P 500 split by sectors. And let's look at the 1 week performance chart here. And what we see is that there's one winner only, and that is energy stocks, which are up by 3.5%. All the others are down, and materials are down the most. And it kind of makes sense. The more a sector is dependent on energy, the more they will suffer. And if you think of materials, so iron and steel manufacturing, energy is a hugely important input factor. But also all the other industries are suffering. They're hit with higher energy costs, even if it's not that pronounced. And here's a chart that shows the importance of energy costs across sectors. And the energy costs are expressed as percent of total revenues. And you can see here that some industries are more dependent on energy than others. For example, transportation, steel, mining and quarrying, paper industry, and building materials are at the top of the list. And now think about it. Oil prices have almost doubled. What's going to happen to these companies? Either they make huge losses or they'll pass on the costs to their consumers. And that's the ultimate consequence. You, me, everyone can expect higher prices, and so inflation will pick up. Now, if you're smart, you don't just wait until this happens. You prepare. And how do you prepare yourself against inflation? Well, ideally, you don't hold too much cash, but invest it in real assets. For example, real estate. If you think about buying, now might be a good time, especially if you can secure a low interest rate that's fixed for a couple of years. High inflation benefits the borrowers. You're going to pay back the loan in the future when the money is worth less than today. Meanwhile, the asset prices will also go up, not just real estate, but equities as well. And now is a great time to buy stocks. As Warren Buffett has said, be fearful when others are greedy and greedy when others are fearful. So while we have a lot of fear in the market right now, it's time to get greedy. And now circling back to my portfolio, I usually make my trade on Friday morning, but the video on the weekend. While making the trade on Friday, I thought I was up with my portfolio, but Friday afternoon the market went down. So for the first time in this video series, we are officially in the loss territory. We are below the 20,000 euros that I invested so far. But, as I always say, now we can buy and get the stocks at a discount. Look at the MSCI emerging markets. At its peak here a couple of weeks ago, we were at 51 euros and now we're at 46. So effectively, we're down 10% from the peak. That means buying now gets you a 10% discount. If the market only just recovers from current levels to the previous highs, we made 10% on that investment. And as far as recorded history goes, ultimately, markets always went up to new highs. You just need a bit of patience. Alright, so that's what I'll leave you with this week. Hope it was interesting. I'll keep an eye on the market and summarize it for you. And until next week, when I make my next trade, take care and all the best.